Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is a very, very special guest, Chief Market Analyst at ITM Trading, the legendary Lynette Zang. Thanks for joining us, Lynette.
It's my pleasure to be here. And
Yes.
thank you for having me. It always makes me laugh when I'm called legendary. I guess that's what happened when you get older.
No, that's
Yeah.
good. You are a legend, especially Lynette. You've been
Distinguished,
talking
distinguished. Do you want to be called
distinguished.
distinguished or legendary?
Distinguished. I don't know. I kind of like eccentric because,
There we go.
that way you really can get away with a whole lot more.
Oh, you're not crazy. You're eccentric. Okay, I got
Correct.
you. All right.
Lynette, you've been talking lots recently about Bailin Laws. Can you explain more for our audience these laws that people don't really understand?
Yes. They put all of your holdings that you have in the bank completely at risk because people just think, well, that's my money I've deposited in the bank. But, part of what I've noticed a lot, and we at ITM have noticed a lot, is how much more narrow and how much harder it is to get your money out of the bank, or dare I say it, even deposited into the bank. It's really kind of interesting what's going on. So the Bailin Laws enable and legalize, that was enacted back in 2010 with Dodd-Frank. And while they've demolished all of the other laws that many of which were never even implemented, let alone actually fully written out yet, but they've basically taken away all of the protections for the public, and they've left them just vulnerable. And so the bail-in laws state that a bank, a failing institution, can take your savings, and what they leave you, because of eminent domain laws, they leave you shares in a failing institution.
Jeez.
Now, we have not done it here yet, but that is a big fat yet. And also a big reason why, yes, I run a business, so there's a certain level that I have to keep in the bank, but I don't keep any more than that level. And that's the level that I'm willing to lose, that it doesn't bother me. If it goes away, it's not gonna have any impact on me one way or the other. But, we can still see the result of what happened when they tested this regime first in Cyprus. And it's been tested many times since then, but first in Cyprus. And what I found quite interesting, and this is a repeatable pattern anyway, is that the people that are behind the scenes manipulating everything and knowing what's going on, right, they get out, right? Because they understand that they're about to lose everything. So in Cyprus, you saw a lot of French and German banks pile in because the interest that Cyprus was paying was much higher. But about 2 years before the bail-in, you think they knew something, huh?
Yeah.
They started liquidating and getting out their positions so that those that were left holding the bag when they did the bail-in were the general Cypriots, the public. And even though they have subsequently allowed them access, that was 2013. I believe it wasn't until 2000 and I have to go back and look, so don't hold me to this, because I think it was like 17 or 18 before the Cypriots actually had full access to their bank accounts. And they took everything that was above the insurance scheme, their words, not mine, but I'd agree with them. Right, the deposit insurance scheme, they took everything above 100,000 euros.
Wow.
So, yeah.
Well, that's a very good point. For people who don't know, Cyprus is part of the European Union, is part of the Eurozone, uses a major world currency, the euro, and it happened there. This wasn't some, nowhere country. This was the European Union. And it's my understanding a lot of Russian oligarchs are the ones who were the bag holders in Cyprus because they weren't in on it. And they had a bunch of money that they had removed it from Russia to protect it from the Russian authorities, parked in the Cyprus banking system for the high interest rates they were receiving. And then they're the ones who basically footed the bill for most of the bail-in. But that's just.
Oh, but they also had access, like in England, they had access to those funds. So there was a workaround as well for those wealthy Russians, for the people that can pull all the strings, right? They have the money, so they have the influence, and which is why you want to own gold and silver, because that's the only form of money that's going to be left that's not completely controlled by the central banks, especially once we go to a CBDC, the central bank digital currency. So if you've got enough money, and that's where I always like to be. If I could be on the side of the guys that get to write the rules, rock and roll hoochie coo. Even if it costs me a little more, I don't care. That's up front. At the back end, it saves you a whole lot more.
David Morgan, he wrote about this also, I don't know, 2 or 3 months ago. And he was interviewed on Stansberry with Daniela Camboni, got like 1 million views talking about the same subject, that the banking system in the United States, the exact same thing could happen as what we saw in Cyprus. So, I mean, this is something to be concerned about. And your advice is well taken. There's no reason to leave $250,000 sitting in a bank reserve, in a checking account or savings account. There's other assets you can be in right now to protect your buying power, right? I mean, obviously we're a silver channel. You love gold. The precious metals is one area, obviously, but we got to think about these things right now, right? Right, Annette?
Oh, 100%. And frankly, I'd rather be 2 weeks too early, 10 years too early, I don't care, than 1 second too late, because that 1 second costs you all choices. And, something that really rarely gets talked about is what's happening with LIBOR and that interest rate transition, which part of it has been postponed until 2023, the biggest share of it. So that they were they're attempting to give, to add some time so that contracts that cannot be converted into the new interest rate regime, the SOFR, they can run off. But Congress just passed and legalized the right for those companies that have those contracts to, like mortgages. Okay, these are the contracts that these aren't the contracts that'll take the system down, but these are the contracts that impact you and me. Mortgages, auto, car loans, let's see, what else? Credit cards, any kind of debt that you as an individual might have, whether it's revolving or it's fixed, okay? Those are all legacy contracts. And so that means that they're tied to the LIBOR, which is about to end, even though they postponed a bunch of those contracts, but you still have part of them that are ending in December 31st.
Wow.
The LIBOR is basically going away. So no new contracts can be written with LIBOR in there anymore. And, we still have all of those contracts that must convert from LIBOR to SOFR. And now we've passed a law that you and I or anybody in the public, well, number one, you'll have no choice. And that means that it's automatically going to convert. And number two, we're sitting on, I think it's 610 trillion in notional value of derivative contracts, according to the Bank for International Settlements. Those are the most current numbers because that's what I'm going to work on, present on Thursday. So I've just been in that data. Most of those are interest rate related, like way huge. The lion's share are interest rate related, though there's quite a few on precious metals as well, which is a great way to suppress the visible price that people look at. So, we're going like, this doesn't matter. I mean, do you ever hear them talk about it on MSM?
No,
never.
I don't talk about it. But yeah, there's a deadline. Well, even when they tested the system with 80 trillion in derivatives, and derivatives are just a big leveraged bet that you can never convert into the underlying, but it's based on the price action on stocks, on bonds, on it can be based on the weather. Most of them are based on interest rates. And all of this is so critical because central banks are absolutely between a rock and a hard place. The economy is slowing down, and so they want those rates to stay low, but inflation is heated up. So in order to, in theory anyway, which is now being tested, in order to slow down that inflation, then they need to raise the rates. Well, if they raise the rates with all of the debt that needs to be rolled over and restructured, even if they're trying to create a smooth transition from LIBOR to SOFR, I mean, this has never in history been done before.
Yeah. You know, you make a good point with all the derivatives and leveraged contracts on all this debt, the interest rate products and everything. There's counterparties on each side of those trades, right? So if the Fed does this, if the Fed pulls back all their QE, if they fully taper to zero, and the rumor has it, you know, they're going to accelerate the taper and make it even faster, you know, to March or April of next year and be done, then everything needs to be repriced. The 10-year bond gets repriced. The entire yield curve gets repriced. And someone's going to be on the wrong side of all those leveraged derivative bets, right?
Exactly.
Would it surprise you if we start having some hedge funds or some banks just implode from being on the wrong side of those trades?
No, because, you know, you're looking at 6.10 trillion notional, which means that nobody really knows the true value that's at risk. That's simply the amount that the market has agreed on. Wow. And then you looked at the price of the contracts, which are minuscule and actually going down, which I think is really interesting. At the same time that the number of derivatives that are in the system are going up. And it's all a shell game, so that you know, people are, and even the guys that are creating this mess, they really are completely unaware of the value that's at risk and the unintended consequences. But you've got that piece with the taper, and then you also have the piece with the shift from the LIBOR to the SOFR, because that means every single contract, even if they are able to make a smooth transition. Let's assume a miracle here for a second and say that they actually can do that. Well, guess what happens to the 610 trillion notional of derivatives in all those contracts? They get repriced again.
Yeah.
So we're looking at a double whammy of repricing in a really short period of time. Is the system strong enough to withstand that? No, it isn't.
Yeah.
You know, Warren Buffett, wasn't it he or someone else who described all these derivatives as the thermonuclear bomb in the financial system, or, you know,
weapons of mass destruction, financial weapons of mass destruction.
Yeah, it's just a matter of time before we start having more of these implode. I mean, everything is so leveraged out the wazoo right now. It just feels like the Fed's on the verge of a huge policy error. And, you know, it's
on the verge of one. Yeah. In my opinion, they've already made it. They've made it over and over and over again.
But they're about to make it even worse. You know, we just had Danielle DiMartino Booth on our channel the other day, and she said they're about to try to taper and raise rates at the same time as we are headed into a recession. It's never been done before. It's like, so yes, it's a mistake of where we are now and what we're doing, but they're about to make another mistake going the other direction. And or that just points out there is no good solution here. Yeah. There is no good solution.
That's it. Yeah. Jim. There is no good solution, because they've painted themselves into a corner where no matter what choice they make, and this is what people really need to understand, no matter what choice they make, The system is so fragile
Mhm.
and so vulnerable. All they have are this.
Where do I get that? Where do I get that? I need one of those.
I know. Well, I'm not going to. I'll tell you later.
Okay.
That's awesome.
But you know, the other thing that people need to understand, because they say taper. Well, who understands a taper? So here's a taper. This is QE.
Brr.
This is a taper.
That's hilarious.
They're still printing the money. I know. It's fabulous.
Just a little bit slower, right?
It's just it's a little less.
Yeah.
They're still doing it. So for them to speed that up, well, let's see, didn't they try raising rates and running off their balance sheet in 2016?
What you just said, in 2016, they tried to do the taper and they failed. See, every cycle right before the recession, they try to raise rates. This was like before the internet bubble. This was before the housing bubble. And this was, you know, what they tried to do, just run off the balance sheet and normalize. And every time they've done it a little bit less successfully, or they reach a ceiling before the economy cracks. And in 2018, 2019, it was around 2.25%, 2.5%. And everyone, that's the big question right now. All right, since then, we've had COVID, we've printed another couple of $1 trillion onto the, everyone's leveraged up in the past couple of years. And the question becomes, all right, what can they do this time? Can they really taper? Can they raise rates at all before things crack? And then what happens?
They can't.
And then what happens after that? Is the big question mark. Does the Fed come rushing back to save everyone? Like
but what can they? But how can they do that? What tools
$3 trillion.
do they? That's it. That's all they have is more money printing.
Yeah.
And as you rightly pointed out, it's not just that. What that graph also shows you, and actually, and if you pulled up the Fed balance sheet, this would show it too, that every time they tried to cut back, I mean, we are completely addicted, the markets, I'm not, but, and I don't think you guys are, because we have real money.
Yeah.
But the markets are completely addicted to money printing. And the other thing, going back even further on that one graph that you just showed, and anybody can find it in the Fred, you know, that it's easy, just Fed funds rate. What you'll notice is that the average amount that they drop interest rates to stimulate borrowing and spending is roughly 5.5 to 5.75%.
Wow. They
don't have that to work with. And there's such an interesting shift that is happening in the whole, I mean, yes, we're going through a whole transition here. So the shifting is not really all that unusual, but you know how we've had these supply chain bottlenecks. And so presumably inflation was running hot and partly, and yes, I'll agree with that, partly because of all of this pent up demand, all of the money that they put into the general public's pocketbook for them to spend. But what's also happened in companies, so, I mean, we're about to see something really, really interesting, is that companies have been ordering. They're not getting the order in, so they're ordering more. And they're ordering more and more and more. And so now, on the other side of this supply chain dry desert, we're going to have a tsunami of products that are shipping.
That's interesting.
I mean, isn't that interesting?
Yeah.
So it's almost like a fragile bridge, you know, that's going like this. And that's what we're going to be seeing. So, I mean, there are so many dangers out there, period.
Yeah. So you're saying, if I understand that correctly, you're saying there's a huge, once that bottleneck of the shipping is removed, we're going to be flooded with then products on the other side. And I guess, does that go to, you know, let's say the one example is the auto industry. All these auto manufacturers, they have tons of cars already built, except for a couple of chips that are missing, that are just waiting in the supply chain. And as soon as right now, there's all this huge imbalance of not enough cars where used cars are going up. But as soon as that supply chain issue with the chips is resolved, then they're flooded with cars, and then auto inventories will skyrocket. I mean,
right. And then think about this, right? If you look again at the Fed and you look at the savings rate, it's back to where it was pre-pandemic levels. So all that excess savings, and now people have been spending. JP Morgan came out with a report this morning on that this is the highest level of credit card spending that they've ever seen.
Wow.
Going into, right? So, and now let's just take that a step further, because I mean, this is just, it's mind blowing, right? So people don't have savings. The normal guy on the street, they do not have savings. Now they're massively racking up this variable rate credit card debt. And we have a flood of product that comes in. How are these consumers going to be able to buy those excess products?
Yeah.
So while you
we're stuffing the channel. We're going to end up with huge oversupply of products, and everyone leveraged out the wazoo, and then probably factories slow down because there's too much in the supply chain. It's we're going to crash from one extreme to the other. That's the hypothesis. Yeah.
Exactly. And so, and then so we've got to absorb these products or we're going to crash. That's deflationary. How do you fight deflation?
Yeah, you print more.
Exactly.
Turn on the printers again. Yeah. So
on steroids.
I love that.
So I mean, look at now. Going full circle back to what we first started talking about, bail-ins. If you hold any money in this system, I don't care whether it's the stock market, the bond market, you go, well, I don't have those because I have annuities. Yes, you do. You have those, whether you realize it or you don't. If you have any wealth in this system, it will all be bailed in, period.
You're at risk. Everyone's at risk who's using that system. And, the way out is, of course, to have some tangible assets outside of the system, right? And that's what we talk about is, you got to sort of opt out. And, can you break this down for us? What is it exactly? I know your title, but what is it that you do for ITM? And what's your actual job with them? And how is ITM different? What are you guys doing differently?
Well, I'm the chief market analyst, and personally, I've been studying these markets on some level since 1964. So, and I've been a stockbroker, I've been a banker, so I understand the language, and I understand, because they have central bank speak. Who can understand that? Somebody that's worked in the industry. If I hadn't done that, I wouldn't have known. But I've been specifically studying currencies and currency life cycles since 1987. And there are repeatable patterns. So I've been with ITM, on June 26th, there will be 20 years.
Wow.
So yes, I've been there a long time. And, basically everybody there, I developed a strategy for myself based upon those repeatable patterns. And I went there once I saw that I had technical confirmation that the dollar was entering its last phase and fiat money, so government-based money was entering its last phase. At ITM Trading, everybody is so brilliant and we all come from a bunch of different backgrounds, but we work together. So what we've done at ITM collectively is made that strategy even better and stronger. And that's what we like to do. We like to work with individuals based on your goals. So you put your goals first, and then it's always the right tool for the job. So I love both gold and both silver. I just like them for different reasons. They have different functions for me, but that's really what makes ITM different. We've been around since 95, so I didn't get there right at the very beginning, but pretty close to the beginning. And we've weathered bear markets in gold, so we know what it all looks like. And with the talent, anybody that calls in, I think would be quite impressed with whoever it is that they're going to talk to, because we are really all about education and putting the client's best interest first, period.
I love that.
And you've been doing the YouTube channel, what, going on 6 years now, as part of
Something like that.
your educational outreach, and that's what most people know you from. Obviously,
Right.
that's where you've gained your fame,
Yes.
your notoriety.
Become a legend.
Yeah,
That's
Which
right.
I find it so funny.
an eccentric legend.
There you
Well, everyone
go.
loves you because I've been to conferences where you're speaking, and
Yes.
when you're at those cocktail receptions, you're just mobbed by everyone, and it's just funny to watch. And you just sit there for hours chatting with anyone, and it's great, and people love you. And
Jimmy, here's the thing. I am here to be of service.
yeah,
That is why I was put on this planet.
yeah.
And even though I can't say that I always understood, because I didn't, I didn't always understand what the universe had in mind, but I was definitely trained and groomed for this moment in time. So
You know what?
whatever anybody needs from me, that's
What
what
people love about you is you bring it down to really understandable language that a lot of these gurus on the internet or on CNBC or Fox Business, they're talking in some very in financial terms, but you break it down in really easy to understand language for people who are not necessarily watching the financial markets full time. And I think that's why you're successful. And I think that's why your YouTube channel is so successful. And, just keep doing it. And that's why we love having you on. Thanks for coming on our channel to share a little with our people too.
It's my pleasure. And I'll even give you a heads up on a new series that I'm going to be starting, like probably once a month, once every 6 weeks, with my 8-year-old grandson.
Oh, that's so smart.
And I'm going to let him ask me questions, and I'm going to figure out how to explain this at an 8-year-old level. And he's a pretty smart 8-year-old.
That's a great idea. Lynette, thank you so much for coming on our channel and sharing some of your knowledge with our audience.
Always.
We really appreciate it.
It's my pleasure.